Hi, everybody. And in this session, I'd like to talk about problems from chapter 5 on financial statement analysis. The problems that are posted as examples, problems 535 and 536 and 537, they're pretty self-explanatory, so it's not going to be a long commentary, but I just want to go through the solutions which are posted on the web to kind of quickly comment on them. So the first question, we are asked to compute return on equity, return on assets, return on financial average, which is actually the first time I ever see this ratio. It's not a very common one, what they call ROFL. And it says for two companies, Nike and Adidas, and we're told that given as statutory tax rates of 30 and 25% respectively. So the first line in the solution is what they call EWI. I don't know what they call EWI, but notice what is it made of. So 2539 is the net income of the company, for in this case for Nike. 89 is the interest expense, which is gross multiplied by 1 minus the tax rate. So what is this 2539 plus 89 minus 1 minus 0.25? This is essentially a calculation of NOPAT, non-operating income after taxes. This is the pre-tax, after-tax operating income. I don't know what EWI stands for. It's not an abbreviation I'm familiar with, and I'm not sure why they even included it here in the solution, but since it's printed, I want to comment on it. So obviously, ROE we know is the return on average equity. If we go by our book, return on assets is net income divided by average assets. So they calculate average equity assets first. Then you can calculate ROE and ROA. And then what they call return on financial average is the difference between ROE and ROA. So in this case, ROE, for example, for Nike is 29.7, ROA for Nike is 29.47. We talked about the fact that for companies that are more heavily leveraged, have more debt, the ROE will be higher than the ROA simply because if you have more debt, dollar for dollar, you have less equity. So it will blow up your ROE. So what this ROFL stands for is this effect, this financial effect, right? It's the difference of ROE minus ROA. It's 20.23%. Now, what you judge from that is, basically, one could argue that the ROFL measures the degree of distortionary effect, if you will, of using ROE. That's why ROA is more biased, less biased metric. And it's interesting enough, it's a good question to see that in. So, for instance, if you compare ROEs of Nike and Adidas, Nike is doing slightly better. However, when you compare ROAs, clearly Adidas does better, right? And that's because Nike disproportionately benefits from this ROFL being higher. It's 20.23 and 17.92, right? So this is purely, you can argue that ROFL is the effect of capital structure on the financial metric, which is not relevant, which is distortionary. So the point of this part of the question is to really focus on the ROA, which is a more valid metric of performance. And when they compare it to companies. And under this metric of performance, Nike clearly does worse than does Adidas. And the second question, we're asked to calculate profit margin and asset turnover, right? I hope you have seen my video on DuPont decomposition. And obviously ROA is the product of profit margin and asset turnover. Profit margin is simply just a ratio of, in this case, I typically just take it as net income to sales. In this case, they're taking this operating income after taxes, NOPAT, after this. That's why they calculated it up here, right? So they're taking a ratio of operating income after taxes divided by sales. In this case, we're given sales somewhere. Yes, we're given sales on the second page. And you can see the profit margins is 6.97 and for Nike and for Adidas 8.85. And so that basically tells us that every dollar of sales for Nike is less profitable than it is for Adidas, which is consistent with Nike kind of having lower ROA, holding everything else constant. What's interesting now that Nike has a higher asset turnover, which is the ratio of sales to average assets. So Nike is in fact more efficient than Adidas, but it's not enough to compensate for the lower profit margin, right? So it still results in a lower ROA, right? So that's the story. Question C asks, compute gross profit margin, operating expense to sales ratio. So gross profit margin is simply the ratio of gross margin, which is difference between sales and cost of goods sold, to sales. And you could, and we're actually given gross profit for 2020. For 2021 is straight in the income statement. So you just take the gross profit divided by sales. And you could see that, in fact, gross profit margin for Nike is lower than it is for Adidas. So kind of Adidas is just better in squeezing profits out of its sales, which is consistent with the net profit margin being higher for Adidas operation. Then you have operating expense to sales ratio. So again, you need to just look up operating expenses in the income statement. And if you look at the income statement, you know what the operating profit is. So you can simply subtract, if you subtract the operating profit from gross margin, I'm sorry, I take it back. They're measuring, they're just taking total selling and administrative expenses. They're taking selling and administrative expenses as the measure of operating expenses, which is 13,126 for Nike in 2020 and 12,293. I'm sorry, 9,633 for Adidas. And you could see that with respect to operating expenses, actually, Adidas does a little bit worse. But overall, they're much more, the gross profit margin is much higher. That's why at the end of the day, they end up doing better. Then the question D asks you to calculate accounts receivable turnover, which is the ratio of sales to average receivables. You can see that accounts receivable turnover for Nike is higher. So they're actually better in collecting their receivables. Same thing with inventory, which is the ratio of cost of goods sold to average inventory. They're also better and they're more efficient with respect to inventory. PP&E turnover, which is the ratio of overall sales to average property owned equipment. That's where it seems to be that Nike is worse, right? So they're good with receivables, they're good with inventory, kind of poor with managing their capital equipment, like with their capital investments, squeezing dollars out of it. So overall, that, if one could argue, that efficiency ratio is very important because it sort of shows your long-term investment, how efficient it is. Receivables and inventory are short-term type of assets, the current assets. But in terms of like overall profitability, if you're capital investment companies, both companies have lots of factories. And so it's important to really squeeze as much as you can out of your sales. So the question E asks, Nike's fiscal year ends on May 31st, 2020. Adidas' fiscal year ends on December 31st, 2019. The difference of 5 months. How does the difference in your analysis of RE and RA for these two companies? So, like overall, this kind of becomes more important, this kind of differences in fiscal year. You want to compare apples to apples. It becomes more like a pricing of companies. But as the solution points out, COVID affected companies differently. So COVID probably kind of affected Nike more, right? Because it's included in the Nike, not Adidas. So that's which is partly why perhaps Nike's performance is not as good. And then finally, last question, it says basically, Nike's financial statements are prepared in accordance to the US GAAP, where Adidas is always IFRS. What is the difference in the financial reporting standards in comparison to those companies? So generally speaking, for things like inventory turnover, receivables turnover, IFRS and US GAAP do not have substantial differences. But for things like asset revaluations, which is what the solution points out, so IFRS allows to mark up of assets to fair value, which US GAAP does not. That could introduce distortionary differences, which could, for example, lead to their PP&E turnover ratio not being comparable. So, and in turn, of course, if there is any things like asset revaluations included in net income for operating income, that would affect things like ROA and so on. I don't think, I'm not sure I agree with which is affecting inventory turnover too much, because as far as I recall, IFRS is not that different than US GAAP when it comes to inventory, but they could have some small nuances. Okay, so this is question 536. Now, question 537 is simply a continuation of question 536. You have to calculate current ratio, which is the ratio of current assets to current liabilities. Notice that, and then kind of look at the trend. There's an improvement clearly in Nike's current ratio, so it becomes kind of more healthy in terms of its liquidity. But there's a clear deterioration for Adidas, right? It goes down from 1.44 to 1.25. That's not a great thing. It suggests there is some sort of a distress. Quick ratio, of course, is the ratio of quick assets, which is things like, if you go look at the solution, things like cash, receivables, and short-term investments in this case. They're things that are very quickly convertible to cash. So if you look at the quick ratio, it's a sum of cash of 83.48. I'm just using Nike as an example. Short-term investments are for 39. And accounts receivable of 27.49, right? And you can see that, again, quick ratio for Nike is improving, whereas the quick ratio for Adidas clearly deteriorated, which is interesting why would be the case, since Adidas seems to be overall doing much better. But again, we just learned from the previous question that Adidas financial statements do not cover COVID effect. So they're not, that's a situation where really we're not necessarily comparing apples to apples, because there is an effect of, we can't really say for sure that Adidas is doing better than Nike, because this non-overlapping, very significant non-overlapping period is, if you recall, early spring of 2020, there was essentially worldwide, very serious, albeit short-term recession, which certainly affected performance of different companies. So that's a good question, in terms of understanding how to compare companies, how to use different types of ratios, and how to kind of infer different effects of different fiscal years and seasonalities and so on to think about. So that's what I have for module 5. Thank you for listening.